Hello and welcome everybody. I'm glad y'all were able to log in. Oh, we have another person joining here. We have Derek Myers here. He is a CPA and he'll be doing our discussion. If there are any questions afterwards, we will be answering as many as possible. Please use the chat box and please try to remain on mute so we can hear each other. I will provide Derek's email address and TSFA's email in the chat later on. Diana is going to be introducing Derek today, and I hope that you guys are able to gather some knowledge, some valuable knowledge from Derek. Diana?
And thank you, Derek, for your expertise. Derek's a business consultant, and he's developed financial strategies that he's shared with this very unique floral industry. He understands this industry really like no other person that I've ever met. His strategies are proven instrumental. He's increasing profitability for many florists across the country. And he's sharing these techniques with us today regarding this very unusual situation that we all find ourselves in with the small business loans and the paycheck protection. In addition to this expertise that he's gained for us right now, he also helps florists reduce costs. He manages staff, saves on our taxes, and in all, he just helps us run a more profitable business. And I'm so grateful that he's given his time today to share with us how to move forward in these very unprecedented times. Derek, thank you, and please begin your presentation.
Thank you, Diana. And thank you, TSA, for having me, Texas State Florist Association. Appreciate the opportunity to share whatever information I can. Been working, I was telling these guys earlier, I've been working pretty much nonstop for the last 2.5 weeks, just trying to digest all this information and help a lot of my clients and a lot of other florists already apply for these loans. So I just want to talk about some of the realistic provisions and some of the things how it's actually working. When the law first passed, we thought we understood it until the banks actually started processing loans, and things have actually changed kind of as the process has been going on. So we're going to kind of give you the most up-to-date information we can and how it's actually working to apply for some of these loans and take advantage of some of these credits and things. I do want to, I got a fantastic introduction. I mean, she made me sound fantastic. We have been working with florists since 1937, wouldn't that be great? For 37 years, since 1983, we started working with our first florists. And we've worked with probably 1,000 or so over that time period. We work with about 130 right now on a regular basis, as Diana was saying, helping them become more profitable, help them analyze their business and see where they're making mistakes, where they're making missteps, how they can capture that money and bring it back in. So that's who we are and what we do. Today I want to go through, I'm going to spend probably most of our time talking about the payroll protection plan loan. This is probably the biggest loan out there right now that everybody should be looking into, if not going after. What makes this loan so great is that unlike most SBA loans, it doesn't require a whole lot of record keeping or bookkeeping. You don't have to have prior year tax returns. You don't have to have a list of assets. You don't have to have financial statements and collateral or personal guarantees. This is all based on payroll. So if you have payroll, you can get this loan. You don't have to have all the other things you need to get normal bank loans or normal SBA loans. So this is really done to help bail out those businesses that have payroll and are trying to help keep their employees employed, okay? So first question I always get is, should I apply for this loan? And my answer is a resounding yes. Absolutely. If you've got employees, if you're in business, you should be applying for this loan. It's an easy process. They've made it very simple, like I was saying. And it's just definitely something you should look at. And we'll talk more about what all is involved. So when can I apply? Applications started April 3rd. So last Friday was the first day anybody could apply. All the big banks weren't ready, and they weren't able to take applications, most of them, until Monday. Some of the smaller banks actually got applications processed on the 3rd of April. So these loans are already underway. People are already applying for them very quickly. There is talk that they could run out of money. They might have to fund more. So the government's already preparing to do additional funding for this loan package if necessary. So you can apply between now and June 30th. If you're a sole proprietor, You get paid by 1099, or you're a contractor, you're independent, working as a sole proprietor. Applications for those started today. So April 10th is the day to start if you're an independent. So that's kind of when it starts and when it goes. So the big questions are, how much can I get? And this loan is pretty powerful. It can pay you up to 2.5 times, or you can borrow up to 2.5 times your average monthly payroll cost. So they actually look at the calendar year. When this all started, they were going to be looking at February 15th of 2019 up to February 15th of 2020. And the bank said, this isn't realistic. We can't verify these numbers in any way. So it got shifted back to a calendar year. And it made it easier, because now all we have to do is provide 941s and 940 reports. That's pretty much all we have to provide to the bank. That, along with a year-to-date payroll statement for the whole year, so that we can show how we're calculating our numbers. And once we have our total payroll cost, it's just 2.5 times that. Very simple. That's what you can borrow. There is a different, if you're a seasonal business, which again, they don't define. So again, some of these things are loose in the law. We don't know really where it's going on yet. And I'll be saying that a lot. There's a lot of things in this law that are changing every day as practicality comes into play, and as we actually see what's going on, these laws are being changed and adjusted a little bit. So for right now, it says if you're a seasonal employer, you take your payroll from February 15th of 2019 through June. You divide it by 4.5, that gives you your average monthly cost that you can use. Then you take that times 2.5. So I would check it both ways, because florists typically are seasonal. I mean, we have, our Valentine's, we have our Mother's Day, we have that spring season that tends to be very strong. So I would look at the calculation both ways to see which way is going to get you the most money. How much I would borrow is as much as this calculation will allow you to borrow. So borrow it all. All right. So what's next? So payroll cost. Let's define that, because payroll cost is very, very specifically spelled out in the law. First thing is, it is wages, overtime, commissions, bonuses. I don't care how you describe it. If it's payroll, if it goes through your payroll, then it counts as part of these costs. It also includes if you have tips that you run through, the cash tips that you collect for your drivers or whatever that you run through payroll, they count as well. Vacations, family leave, sick leave, any personal time, anything you're paying through your payroll counts. If you let someone go and you gave them a severance package and you paid them severance pay last year, that would qualify. Group health benefits, which are a big one, but only the company portion. So not the, for like if you got health insurance, any portion that the employee pays doesn't qualify, but whatever the company pays, that counts as payroll costs in this situation. Retirement benefits, if you have simple plans or 401k plans, the matching that the company does is counted into payroll cost. And finally, they add in any state and local employer taxes. So not withholdings or anything like that, but any employer taxes like unemployment, pretty much that's probably going to be the only one. So all of these things become payroll costs. We add all of these up for that time period, for the calendar year, and then we divide it by 12, multiply it by 2.5. That gives us the amount that we can borrow. Okay? So a lot of people are getting confused with the rents and the utilities and all that kind of stuff. That's not used that doesn't use to calculate the amount you can borrow. That's used to calculate the forgiveness, which we'll talk about a little bit later. So the borrowing part is just basically all your payroll cost per month times 2.5. Now, what do the funds have to be used for? Well, it's kind of a catch-20. It's kind of a wrong phrase, because you don't have to use the funds for anything specific. But if you want them to be forgiven, then they have to be used for certain things. So basically, this loan, I mean, what's so wonderful about this loan is potentially it can be 100% forgiven. So we borrow this money 2.5 times our annual pay, our monthly payroll. We've used it for the right thing, and we don't have to pay it back. And that's what makes this loan so powerful. So what can we spend it on? Well, we can spend it on payroll costs. That's those same list that we just went through. All of those different things count as a use of funds. You can spend it on interest on mortgage obligations. Now, of course, these would be your company obligations, not your personal obligations. But if your company has a mortgage buying a building or something, that interest on that mortgage is a appropriate use. If you pay any rents under a valid lease agreement, you can deduct those rents, even if they're paid to yourself. If you own the building and you pay rents from your company to yourself, as long as you have a lease agreement in place before February 15th, then you're okay. Covered utility payments. I had to break this one down. This is a specific term again that they give a lot of detail in. So I broke this one down for you. Covered utility payments include quite a few things. It's basically all of your electricity, your water, your gas, your telephones, your internet access. Now they throw transportation in there, and I'm kind of confused what they're referring to. All of this has to do with the delivery of utilities. So I think it's a utility thing. I know they're not talking about your delivery fleet or your own delivery. They're talking about something transportation to do with utilities. I don't quite get the term, but I just want to make sure you understand that's not your paying for your delivery fleet and paying for all your delivery costs. So that's your utilities and so forth. Also, if you have any interest on any other obligations that aren't mortgages, maybe you have vehicle loans or other kind of loans that you have through your company, as long as they're company debt, any interest on those obligations is a qualifying fund, or qualifying use of funds. Now, not the principal on the loans, just the interest portion. Okay? And I think that's it. So those are your use of funds. Now, if you use the money for those funds, a large chunk of this can be forgiven. So let's look at how the forgiveness gets calculated. And this is the area that gets really tricky because it hasn't been defined yet. They've done really good at defining how much we can borrow. They've narrowed that down really well because the banks are lending the money out already. The forgiveness doesn't even get calculated until after June 30th. So right now they haven't worked too hard on nailing these numbers down, and you'll see some of my questions in a minute. So I'm going to throw as many questions as I give you answers in this section, unfortunately. So the forgiveness is based on what we spend the 8 weeks after we get our money. So we apply for this loan, we figure out how much we're going to get, we get the loan. They hand us the money. We now have, our clock starts. We have 8 weeks to spend this money, okay? If we spend it on all of those things that we said were appropriate uses, payroll and rents and utilities and all that, potentially 100% of it can be forgiven, which is pretty amazing. Now I say potentially, it could qualify, and it's only potentially because there's some caveats. The first possible reduction in that forgiveness amount comes from, we have to use 75% of those funds during that funding period, during that 8 weeks. 75% of it has to be spent on payroll cost. So if we spend a lot on rents and a lot on mortgage interest and a lot on utilities and a lot on other things, if it's more than 25, there's going to be some kind of a reduction in our forgiveness. Problem is we don't know how much, and we don't know how they're going to calculate it. It's very vague right now. The next reduction is based on FTEs. So they're going to look at our full-time equivalents, or full-time employees last year for the calendar year compared to our 8 weeks. And actually, we have up until June 30th to get our full-time equivalents back. So even if we spend all of our money in 8 weeks, and let's say our 8 weeks ends May 15th, we still have until June 30th to bring more people back into our staff to get equal with where we were last year. If we're equal in FTEs, then we theoretically can get 100% forgiven. If we have half as many FTEs, then our forgiveness is probably going to be limited to half or something close to that. Now, another area that we have no answer on, no directive on, is what is an FTE? Full-time equivalents have many definitions in the tax law, and they did not tell us which one we're using. So an FTE, if you look at the ACA, the Affordable Care Act, an FTE is 30 hours. If you look at the typical full-time equivalent in the rest of the law, it's 40 hours. There are places it's referred to as 32 hours. We don't know what we're using for an FTE here. It's not defined. So this is going to be one of the things they're going to have to hammer out before they start figuring out the forgiveness portion of these loans. I think as long as we're consistent in the application of what we use, it's going to work out fine. But until we know for sure, those definitions are going to shift just a little bit. The other thing that they look at too is they're going to look at employees on an individual basis. And if employees drop by more than 25%, again, there's going to be some kind of an adjustment. We don't know how they're going to calculate it or what they're going to do, but there's going to be some kind of an adjustment based on this. So what they're trying to do here is they're trying to keep people from saying, let's get our payroll cost up so we're over the 75, we'll pay the owners a whole lot more money just to get our payroll up so we're over 75% of the cost, but we're going to drop some of the other people because they're not working full-time or whatever, or maybe they're working a little bit less. All of this is going to be factored in. So, and again, we don't know how yet. So they're going to be looking at a variety of things. Percentage of usage in the money, FTEs this year compared to last year, and payroll, how it's dropping on an individual basis. So these calculations are still very, very vague, but I know they'll be hammering them out in the next month or so as we get ready to get into those. So that's pretty much the PPP plan. The biggest thing is, if you get this forgiveness, and if you get 100% forgiveness on this loan, which is very possible, it's not taxable income either. So not only is it free money, we don't even have to pay taxes on the forgiveness. And normally if a loan is forgiven, it becomes income to you. In this case, it's not. So it's a true win-win. I mean, if you get the money and you use it for the right purpose, it's 100% forgiven and it's not income. So, I mean, it's a phenomenal loan. So I recommend, if you haven't gone after it, go after it. This loan, I'll talk about the process of getting it a little bit. I didn't really go into it here. It's a very easy loan application process. You basically go onto the SBA.gov site. No, I'm sorry. This is the bank. Well, this one goes to the bank. PPP is the bank. You have to find your local bank. Your local banker has to be an SBA lender or qualified lender, which they've expanded the list of people who can qualify for that, or banks that can qualify for that. So you go to your local bank, they're going to give you an application. And the application basically just says, what is your average monthly payroll times 2.5? This is how much we're going to lend you. They do ask you how many employees you have or full-time equivalents that you have. And that's it for numbers. The rest of it are just questions that you check off, saying, they ask you things like, have you been convicted of a felony in the last 5 years, and basic questions. Answer the questions, answer them all truthfully, send in your application, and that's it. There's not a lot of stuff. They do ask for a little bit of supporting documents. You'll need 941 taxes, the quarterly reports, a 940 report, a W-3, and of course all those better match. If they don't match, then you got problems. And then they're going to look for probably a 12-month recap of your payroll from either out of QuickBooks or from one of your payroll companies, just so they can look at your gross pay and add back things like your pension plans and different benefit costs. That's the whole loan. Once you have your paperwork together, the application takes all of 15 minutes. It's very, very simple, very, very easy. So that's the PPP loan. All right, let's talk about the other loan that's out there. This is the Economic Injury Disaster Loan, or the EIDL loan. This one's also a quick initial application, very easy. And I say initial because this is a two-step loan. First, we go online, we apply, we put in our application. This one is done at SBA.gov. And usually there's been a yellow bar right at the top of the screen. You just click on this yellow bar and it takes you right to the application. Again, they only ask you for two numbers. It wants to know your gross payroll, your gross wage or gross income, gross sales, from February 1st to January 31st. And it wants to know your cost of goods for the same period. I think that's up here, yeah. So this is all you need. These two things are the only two numbers you'll need for this application. Again, another very, very simple one. They're trying to make this easy for us to get money and to get help, okay? So you just need those couple of things to make your application online. What else am I going next? Yeah. Once you put in this application, again, this initial application is very easy. Two numbers, answer some questions, very simple. You have to put in like information about who are the owners and what percentage they own and some basic questions. Nothing that's tricky. Once you apply for this, there's a little checkoff box that says, I would like the emergency relief grant money. And if you qualify for that, which they determine that, there's no way that we know ahead of time. I don't even know what their qualifications are. They will send you an emergency grant up to $10,000. And that grant is, you don't have to pay it back. It's not part of the loan. It's just a grant. It is a taxable grant. You do pay taxes on the income, but they'll give you 10 grand like right away. Here's your money to help you out, keep you afloat while you're going through these difficult months. So it's a very quick thing. Once you get past that, then you can borrow up to $200,000 through this loan. Now it becomes a true loan. And now we get into more of the standard SBA documentation. Once you process the initial application, they'll send you the 10 grand if you qualify for it. After that, they're going to hook you up with an SBA lender, and they're going to say, okay, you guys work out the details and for the rest of your loan, and they're going to want 3 years of tax returns and financial statements and personal guarantees and asset lists and all the stuff that banks always want to get loans out. But that 10 grand is an initial fast thing that you don't have to pay back, and it's quick and it's done without any of that other stuff. You can get both loans, but there are some restrictions. You can't use them for the same things. If you do get the $10,000 up front, that reduces the amount of forgiveness on your PPP loan. So there are some, interplay between the two loans. I would recommend go for the $10,000 grant. If you get it, fantastic. Go for your PPP loan. If you get that, you may not even need to go to follow up on the rest of the EIDL loan. But if you do, if you need more funds than you can get through the PPP, you can continue to get them through here. Okay. So I know this is crazy and it's a lot, and I'm just kind of blow through it, and then we'll go through questions. So we can go through questions and get some of your details hammered out. All right, so that's the two loan provisions. There's a couple other things going on. Right now they have the expanded FMLA Act, and this one is very confusing for people. And really what happens here is if you have an employee who is still active, okay, if you've already laid people off, then this provision doesn't qualify. But if you're still employing people, if you're still working and you've got people employed and one of your employees gets quarantined by a doctor, okay, or they have to go home and take care of someone that's sick, or they have to go home because they're a high-risk person and they want to be there as a preventative measure, they want to be home. If someone takes off for any of these reasons, you have to pay them 2 weeks' pay, even though they're not working. So you have to continue their pay at their normal pay rate, at their normal number of hours. So if they work a 30-hour week, you pay them a 30-hour week. If they work a 40-hour week, you pay them a 40-hour week. Okay, so you pay them their normal week's pay, and then you turn around and you get a credit back for this. Oh, in a minute. You get a credit back for this against your payroll taxes. So you put the money out up front, but then you get it all back through your payroll, through a payroll tax credit. Okay. But this is really where it confuses everybody is when they say, well, I've already laid off my people. Do I have to pay this? Well, no, if you've already laid them off and they're on unemployment, you're done. Your obligations are finished. This is for people who are actively working and then find themselves sick or have to go home and take care of the sick. Okay. Now, if they have to go home and take care of children, you have to pay them up to 12 weeks to be home with their children at 2/3 pay. So again, 2/3 of their normal pay. So if they're a 30-hour employee, it's going to be 2/3 of 30 hours, which would be 20 hours. You pay them their normal pay for 12 weeks, 2/3 of it, and then that is also paid back through reimbursement of your payroll taxes. Now, if your payroll taxes aren't sufficient to cover the money that you're fronting out, the balance will be refunded to you. Now, again, we don't know how this is going to work yet. I assume we're going to see new 941 reports that look different, that have a place to take this credit and get this money refunded to us, but we haven't seen them yet. There's nothing on the EFTPS site yet that says, hey, I'm making my payroll payment. How do I take this credit? It's not there yet. So all of this stuff is still so new. It's still in the works, but you're going to get the money back. There's a credit going to give you this money back. So you're putting it out up front, but you will get it back. And again, this is only for active employees. If you've already put them on just, unemployment or whatever, then you don't have to worry about this, right? So that's the FMLA. All right, a couple other quick issues, and then we'll open up for questions. The next big one is extensions. Almost everything has been extended right now. From the IRS, from the Internal Revenue, anything that was due between April 1st and July 15th is now due July 15th. So if you have a tax return due April 15th, it's now due July 15th. If you have a corporate return that's due June 30th, it's now due July 15th. Whatever you have, whatever is due within that period is now due on July 15th. If you have an estimated tax due on April 15th, it's now due July 15th. Okay, so they pushed all deadlines to July 15th. Now, and this is not just the filing deadline, it's also the payment deadline. So if you owe money, you don't have to pay it until July 15th. If you have estimated taxes, again, not due until July 15th. So it's the due date and the payment amount. Everything's been pushed. That includes personal, corporate, trust, anything. It doesn't matter what it is. First quarter estimates. Also, Texas, I know they've extended their franchise tax to July 15th. I'm not sure what other provisions Texas has done. I know in Maryland, where I'm at, our property taxes have been delayed. We don't have to pay our property taxes until late. Our personal properties tax return, which is normally due on April 15th, has been extended to July 15th. So I know you really need to check your personal state and see what's available. Also, check your state for other loan options or grant options. I know Maryland has a grant for $10,000 you can qualify for, and a loan up to $50,000 at very low interest rates. So check your state too, see what all is available there. There might be some other help available beside the federal level stuff. What else we got? Another one that I don't recommend taking advantage of, but I just got to share it with you because it's out there. Effective back to, I think, March 1st, you can not pay your employer matching FICA and Medicare taxes. So you still have to remit the withholding taxes, the withholding side, the Social Security, Medicare, and federal withholding. They still have to be remitted, but the company matching doesn't have to be paid. And you can defer payment of that from now all the way to the end of the year. And then whatever you defer, that amount gets split into two payments. Half of it is due the following December on 21st, 2021, and then the other half is due December 31st, 2022. So it gives you a chance to push a little bit of money further down the road. Shouldn't be too big of an issue because it's only, like I say, it's only the matching, which is 7.65% of your payroll. So it's not a huge number, but it could help a little bit if you're really tight on cash. Last thing I want to talk about real quick are just net operating losses. We're probably going to see more of those this year than we've seen in a while. For those of you who don't know, back in 2018, when they changed the law, they changed the rule on net operating losses. And the new rule said that we can't carry them backwards anymore. So effective that new law, we could not carry them backwards, and we could only carry 80% forward. Okay, they just changed all that, and now we're allowed to carry them back. And not only can we carry them back, we can carry them back 5 years. Typically it was 3, so they're now letting us carry them back 5 years. So if we have a big loss this year because of lack of volume, we can potentially take that backwards and get an immediate refund on some prior year taxes. So alternatively, we can also carry it forward again, but now it's at 100%. So we're not being limited to an 80% carry forward. So we can carry 100% backwards for 5 years or forwards. So if you've been making money all along, or maybe you haven't been making money all along, and carrying it backwards does you no good, you can carry it forward now at 100%. Okay. So again, talk with your tax guy, see what's going to work best for you, whether you should carry it backwards or forwards. But 5 years gives us a pretty good window. So if you had some really good years in the last 3-4 years, you might be able to use these losses up and get some healthy refunds back. And of course, those can be followed right away, and you can get that money as quickly as possible. All right, that's pretty much what I got. So let's open it up for questions and see what questions everybody's got. I think that's where we're going to find out more of what's going on. So any questions?
Okay. There was one that came in from Gina. She asked, if you get the grant, what did you say about that comes out of PPP?
Yeah, what happens with the grant? And again, so much of this is vague. It's part of your forgiveness calculation. So if you get the $10,000 up front, when they calculate your forgiveness by the amount you got of a grant. So you can't get it forgiven twice is essentially what happens. So we get the grant money, they reduce the amount that we get forgiven on the PPP loan. The difference is the grant money it came out a lot faster. I've only heard of one person getting a PPP loan so far, that they actually got the money. The grants were coming out a lot faster.
Okay. Are there any other questions? Anybody have any questions?
No, I didn't answer it all that good. Come on, I know there's.
We can.
I have a couple. Well, one, I've had a call from a member that they had applied for the PPP loan, and then the bank said they needed more information. When the more information got to them, the bank's overloaded with applications and can't even get their application processed at this time at all.
Oh, man.
So they have a relationship with that bank, and to go anywhere else, there's no relationship. How do they find a lender now that can help them?
I'm not even sure they can. Most lenders, I think it's a requirement that you're a customer of the bank. So even if you go to a new lender, you probably have to open a business account and try develop a new relationship. My suggestion in that case would be trying to find a small local bank that's doing it. The big lenders are just being inundated. I mean, they're getting just crushed. The ones that actually had things happen, the one that I was talking about that actually got their money, they used a small local bank, and they got their application in on Friday. None of the big banks were even accepting applications until Monday, if that soon. And I think the smaller banks are the way to go if you've got the relationship. And if you don't, try to find one that can start working with you, open an account there and try to get going.
Have you heard of any credit unions that are taking these 7A loans?
You know, I haven't, but I'm sure there are. There've got to be.
Okay.
I know that the whole idea of this, I forget the number, but there was a huge number of banks and things that were normally not SBA lenders that were going to be expanded and allowed to offer these PPP loans. So they're trying to make it easy for everybody to get to. But no, that's a great question. But I would say try a local bank, check with the credit union, see if they've been approved. I would check with anybody and see if you can find a local bank that can do it. But the big banks are definitely getting overloaded.
So as a question on behalf of the Texas State Florist Association, who's a 501c6, we are not eligible in any of this to apply for any of the payroll protection or the loans. Yeah. So I'm hoping something changes for that, because we have as many expenses as anyone else in the nonprofit world. Right. They just didn't include any of the nonprofits in any of this.
For this past, now there are I've heard there are 2 more loan provisions that they're still working on that are supposed to be coming later. They were hoping that this one was going to solve most of the problems, but they have other provisions in the wings that they're going to be unveiling later if they need them. Hopefully something for the 501cs will be in there, but
yeah, I hope so.
At this point, they've all been excluded.
Yeah. Yeah. Amanda, do you see any other questions?
Other questions?
I have a question. Can you hear me?
Yes.
Okay. I was just wondering how, if at all, are the banks profiting off of all of this?
Oh, well, the banks get paid. I believe the banks get a 5% fee off of every loan they process. So they're profiting very well. Out of what, $349 billion that has been released in this first loan, 5% of it is going to go to the banks.
Okay, thank you.
So they do very well. Yeah, so that's how they get paid. Any other questions?
Somebody said in the chat, I don't know if some people may not have the webinar going physically. You have to have an account before all of this happen with the bank before you can apply for those loans.
Yeah, generally, they're going to want you to be a business client of theirs before they're going to start lending you these loans. So even if you go to a local bank, you're going to have to open an account and become a hopefully it doesn't have to be open before February 15th, which was one of the, I don't think that's a stipulation in this case. I'm not sure.
Have you heard of any other questions, Derek, that's pertinent from other webinars you've done that might help?
I tried to put all those into what I did. So all those questions are pretty much wrapped into here. So yeah, there's not much more I can think of.
Okay. Well, there are a lot of resources at tsfa.org. There was just another Texas Department of Agriculture $10,000 loan. Oh, nice. It's not forgiveness, but it's a loan through TDA. So that's at tsfa.org. And as we continue to get more information, it will be at tsfa.org. And Derek is going to have a few pages in our May Texas in Bloom magazine going over all of this and other things. So please take a moment to open that magazine and look at Derek's information there.
Okay.
I know you guys have more questions.
Feel free to talk, unmute your microphones. If it's easier to just speak up, or if you want to just type in the chat, you can do that as well. I'm just shocked.
Yeah.
You've done a good job in explaining it, Derek.
Yeah, I'm surprised. Yeah. I mean, but like I say, take advantage of these. These provisions are really, really good provisions for small business, and they're going to help us get through this time.
Well, I have a question.
Mhm.
If you have furloughed employees and now you're getting busy again, because I know some of the Texas retail is getting busy.
Yeah.
How do you bring them back in and allocate that furlough on your payroll protection loan?
Yeah, I mean, that's a great point, because as you bring them back, and the question too is, this is a question that I've heard a few times, and it really comes down to, hey, I get my money, should I hire everybody back? And I'm going to say probably not. I'm going to say bring them back as you need them. Okay, so I know it's important to spend this money on payroll, but all that does, that calculates the forgiveness portion. There's nothing wrong if only half this loan gets forgiven. The other half of it, then it becomes a loan. And the loan is at 1% interest for 2 years with a deferral of 6 months payments, minimum deferral. So for a minimum of 6 months, you make no payments, and it's a 1% loan. At the end of 2 years, if it's not paid off, then they're going to refinance any balance at that point. So it's not the worst thing in the world if you don't use all of this and get it forgiven. So
At 1%, of course it isn't.
1%, it's a fantastic loan. You're not. It's the cheapest money you're ever going to borrow.
I would guess.
So, yeah. So even if I wouldn't recommend running out and hiring everybody back immediately just because you got the money. So bring them in as you need them, work them back up. Now we know if we get the money, a week before Mother's Day, I got a feeling this is going to be a pretty busy Mother's Day. I mean, when you think about where we are, there's so many things that we can't do with our moms this Mother's Day. You can't take them out to dinner most places. You can't go out anywhere. You can't do anything. So you give them something. And I think having flowers delivered is going to be a pretty big choice this year. Probably more so than it has been because of the limitations of what's going on. So you may find you have to bring a lot of people in. So for Mother's Day, if you ramp up a lot and then you go back down, again, you just got to make sure by the end of June, you're kind of where you want to be. So if you're going to come back and you think, all right, I'm only going to be 3/4 staffed, and that's where I'm going to hold it, you have until June 30th to get to that point and stabilize out. And that's how they're going to help. That's where they're going to pull your FTE numbers from. So,
do you know, is unemployment rates going to go up if you lay people off?
most states have waived that. So it's a state-by-state thing. I know here in Maryland and a bunch of other states, you're not being penalized for the unemployment, which is a big deal because I know, I unemployed one person, I think, in the last, 15 years, and it cost me $5,000 next time I did unemployment. I was like, are you kidding me? This is crazy. So it's not supposed to affect your unemployment rates in most states. Again, Texas, I'm not sure. I would check. Do you guys know by any chance? Does anybody know in the group? I don't know if Texas is going to forgive it or not. But
I have not heard.
Most states are not increasing your rates because of the unemployment because of this.
It's going to be tremendous if they do.
It's crazy. And I think that's why the feds are kicking in money and everything else for this purpose. I mean, it's all going on. One of the other big questions I hear about.
We had another question. I'm sorry to interrupt.
Okay,
if you get the grant, do you have to accept the loan?
No.
Okay.
You'll have to go through the loan process, and you can always say, I'm getting the PPP loan. I don't need to do this one right now. So you don't have to accept the loan just because you get the grant.
And another question was, whose responsibility is it to take advantage of FMLA, employer or employee?
Wow, that's a great question, and that's a good question for an employment lawyer because I don't know that one. I would think, God, I really don't know. I don't know the answer to that. I don't even want to speculate. I would ask a lawyer. I know that you're obligated. I don't know whether the employee brings it up or not. I don't think that changes that obligation. So I would say you're probably obligated to pay it for those purposes. Let me go back to the other thing that I was just thinking of, if I can remember it. Oh no, I'm not going to remember it. Good one. Nope, it's gone. Any other questions?
Well, if there aren't any more questions within the next couple moments, I want to thank you, Derek, so very much for sharing your time with us today. Your information will be in our magazine. It'll be posted on our website. And, oh, here's a question.
Okay.
What happens to the grant if you don't accept the loan?
I believe you keep the grant.
You keep it? Okay.
It's reduced off your PPP forgiveness.
Okay.
Yeah.
So, and I know Derek has provided his phone number at the beginning and his email at the beginning of this webinar, and he's very knowledgeable. So please feel free to give him a call, and I know he'll take the time to try to guide you through what you're needing. Derek, do you have any additional closing remarks?
No, not really. Thank you very much. I mean, feel free to share the slide thing with anybody that wants it, so that
Okay.
you want to look at the numbers they can. It is also going to be in that article. I think it goes in a little bit more detail in the article, some of the stuff. So thank you guys again for the opportunity.